Imagine having sort of a crystal ball for corporate earnings, cutting through all the noise to see what really matters. Well, that's pretty much what we're aiming for today. We're doing a deep dive into the latest financial pulse of, frankly, a pretty unique company.
Exactly. We're going to unpack the Q2 2025 results for equity lifestyle properties, ELS for short. Now, ELS is a REIT, that's a real estate investment trust, self-managed, self-administered. They own and run this really interesting mix of manufactured home communities and RV or marina properties.
Right.
And our mission here is to pull out the key takeaways from their earnings call, the press release, basically help you understand what's driving their performance and, what it tells us about their business model.
Yeah, we've got the full transcript from their Q2 call, the news release, too. Think of this as your backstage pass, maybe.
Yeah.
To understand a corner of the real estate market that, well, it might just surprise you.
It often does.
So let's kick off with the big picture. The headline numbers.
Yeah.
How's ELS looking financially right now?
Okay, big picture. The top line results, they really show continued strength. For Q2 2025, their normalized funds from operations, that's NFFO, or just FFO, a key REIT metric like cash flow, it was $0.69 per share.
Okay.
And that's up 4.7% from last year. Pretty solid. Year to date, we're looking at $1.52 per share, which is up 5.7%.
Those are definitely solid numbers to start with. What about the revenue side, and maybe more critically, how are they managing costs? Because that's always a big story.
Right, and that's actually one of the standout points here, their grip on expenses. So core property operating revenues, they climbed a healthy 3.5% in the quarter. But get this, core property operating expenses were basically flat in Q2.
Flat? Wow.
Yeah, flat. And only up 0.7% year to date. That really speaks to effective cost control.
Absolutely.
And the result, a really robust 6.4% growth in their core income from property operations just for the quarter. It shows real operational discipline.
So strong Q2, tight costs. How does this translate into their outlook for the full year? Are they adjusting guidance given, all the market uncertainty out there?
Well, that's another interesting piece. Despite, like you said, broader market jitters, ELS actually maintained its full year 2025 guidance for normalized FFO. They're keeping it at $3.06 per share at the midpoint.
Okay.
Now, that projected growth rate over 2024 is modest, only 0.9%, but the consistency itself, holding that guidance steady, it points straight to the underlying stability of their business model.
Right. It suggests they feel pretty insulated.
Exactly. A kind of resilience you don't always see.
So for you listening in, what's the real takeaway from these headline figures? Why should you care about ELS's FFO and expense control?
Well, if you track real estate or even just look for stable business models, ELS is a fascinating case study. These aren't just numbers on a page. They paint a picture of a company that's demonstrating real resilience, operational strength in its specific niche. It offers a unique perspective on defensive growth within real estate.
Okay, from that big picture, let's dig into the specifics, starting with their manufactured home portfolio, the MH side. You said it seems like the bedrock.
Absolutely the bedrock. The MH portfolio makes up about 60% of their total revenue. And the key here, what makes it so foundational, is the resident base. They have over 94% occupancy portfolio-wide, 93.9% specifically in Q2. And this is the kicker. A huge 97% of those residents own their homes. They're homeowners.
97% homeowners. That's incredible. How does that specific factor create so much stability?
It's a direct link. That high level of owner occupation means much, much lower turnover. People just don't move as often. The average length of stay is around 10 years.
10 years, wow.
Yeah, so for ELS, that translates directly into very consistent, predictable cash flow and significantly less operating volatility compared to, say, apartment REITs or other rental models. It's a built-in stability factor.
And given how much everyone talks about interest rates lately, how does this MH portfolio stack up? Is it, uniquely shielded?
It really is. And this is, I think, one of the most fascinating parts. Around 90% of their manufactured home customers pay cash for the home itself.
Okay, wait, cash, not financing.
Mostly cash. Think about what that means. These home buyers are far less sensitive to rising interest rates than someone getting a traditional mortgage.
Right.
It gives ELS this really unique insulation from those broader economic headwinds that hammer the traditional housing market. It's a significant advantage right now.
That cash buyer angle is powerful. So how are they using that strength? Are they investing heavily in this segment, developing new sites?
They are. They're strategically putting money into new home inventory, focusing on key markets. Think Florida, California, Arizona. Those make up about 2/3 of their MH revenue. So, like, in Florida, they've really capitalized on people moving in. Sold nearly 700 new homes just in the Tampa-St. Pete area over the last 5 years.
Hmm.
And Arizona, perfect for the aging population looking for affordable, low-maintenance living. They've sold 800 homes there, added 700 new development sites near Phoenix and Mesa recently. They're meeting a very specific demographic need.
Got it. Now, you mentioned occupancy was 93.9%. I think the reports noted a slight dip quarter over quarter. Can you unpack that? Because it might seem a bit contradictory.
Yeah, good point. And they addressed this on the call. It's important context. While the percentage ticked down slightly from maybe 94.4% to 93.9%, it's not really about losing residents.
Okay.
It's mainly because the denominator increased. They're actively adding new experience sites to the portfolio, so more potential spots available.
Ah, right. So the overall pool got bigger.
Exactly. The actual loss of occupied sites in the quarter was tiny, like 40 sites across the whole portfolio, negligible. What the company stresses is that growth in the number of occupied sites is the real revenue driver, not just holding a static percentage.
Makes sense. And what's a pace like for new home sales within MH and developing those new sites?
So new home sales were 116 in Q2. It's currently at the lower end of their typical pre-COVID range, which was usually around 500 to 600 homes per year. There's been some moderation in average prices too, especially for the higher-end homes, and the mix of inventory affects that average price as well. As for development, when they build new MH sites, the plan is usually to get them occupied within about 3 to 4 years. They try to match development to expected demand.
Okay, so MH is the stable anchor. Let's shift gears to the other side of the coin.
Okay.
The RV and marina portfolio. This seems like it would have a different kind of energy, maybe more seasonality.
Definitely more dynamic, yeah. This segment saw 3.9% year-to-date growth in its annual RV revenue. And the customer base is interesting, kind of split. About 70% of the annual revenue comes from their Sunbelt locations. Those cater mostly to retirees, semi-retirees, similar demographic to their MH residents, looking for longer stays in warmer weather.
Break as snowbirds.
Pretty much. Then the other 30% comes from properties focused on summer seasons, attracting more families, people looking for shorter recreational trips.
So that mix helps balance things out over the year.
Exactly. That seasonal balance helps smooth out the revenue stream, provides more stable recurring income throughout the year than if they were purely focused on one season.
And it sounds like they invest heavily in the experience in this segment, too. I saw something about awards.
They do, and they're clearly proud of it. 55 of their RV resorts and campgrounds actually got the 2025 TripAdvisor Traveler's Choice Award.
Oh, wow.
Yeah, that's a big deal. Only about 10% of businesses listed on TripAdvisor get that. It really highlights their focus on the guest experience. And they mentioned guest referrals are a top source for new customers, so that quality clearly pays off.
That focus on quality is great, but we did see a slight nudge downwards in the full-year guidance, specifically for RV and marina annual revenue. What happened there?
Right. That adjustment was primarily driven by missing their target in Q2. The annual revenue side was unfavorable by about $700,000 in the quarter.
Okay, and what caused the miss?
The main culprit was higher attrition, basically. More people giving up their annual spots than expected. This was particularly noticeable in the North and Northeast, maybe impacting around 20 properties. Historically, their annual turnover is around 5%, but they saw it tick up, likely coming off those, super high demand periods during COVID. People's habits are shifting, maybe.
Okay.
And on the marina side specifically, they had a couple of properties hit by storm damage, which took some boat slips offline temporarily. That contributed to.
Gotcha. And what about the transient side of RV and marinas, the shorter stays? How did that fare?
Yeah, the transient business, which always has a really short booking window, definitely felt the weather in Q2. It was cooler and rainier than usual, especially across the northern and south central U.S. That directly led to a dip in their seasonal and transient rental income year to date. It's just much more exposed to immediate factors like bad weather.
But even though it's more volatile, does that transient business still play an important strategic role for ELS?
Oh, absolutely. It's crucial, actually. Despite the ups and downs, they see the transient business as a vital feeder system for their much more stable annual business.
Like a pipeline.
Exactly. A primary goal is always to convert those transient short-term guests into becoming annual site holders. That's the long-term win. So while, yes, some turnover from the summer-focused properties does impact next year's starting occupancy, they do expect RV annual revenue growth to pick back up, to accelerate, actually, in Q3 and Q4. That's mainly due to standard rate increases kicking in for the annuals.
Okay, that makes sense. Moving beyond the two main property types, let's talk about overall operations and financial management. I saw some interesting news about their Thousand Trails membership program.
Yes, that was definitely a positive signal. Thousand Trails, that's their system. With about 24,000 campsites across 80 properties, it actually saw a slight increase in the total number of members this quarter.
After declines, right?
Exactly, after more than 10 straight quarters of the membership count shrinking. So this is seen as a real green shoot. Paid new member sales are actually beating pre-COVID levels now, and even the promotional signups increased for the second quarter in a row.
Hmm.
They also launched a new kind of upgrade product. It's dues-based, offers better benefits for an annual fee, somewhere between $1,500 and $3,500. Seems to be catching on.
Interesting turnaround there. And we touched on it earlier, but their overall expense control seems really impressive. How are they pulling that off so effectively?
They really are disciplined here. We saw core operating expenses were flat in Q2, came in well under their own guidance. A lot of that was savings in utilities, payroll, some membership costs, and even real estate taxes came in lower than expected.
So actively managed savings.
Very actively. They even use technology like scheduling platforms at the RV parks to manage staffing better and reduce overtime, especially when occupancy fluctuates. It's a really granular, hands-on approach to efficiency.
And the foundation for all this, their balance sheet. How solid is their financial footing?
Very solid. Their balance sheet looks really well positioned. For starters, they have no secured debt coming due before 2028. That's a good ways out.
Yeah.
The weighted average maturity for all their debt is almost 8 years. Their debt to EBITDA, that's a key leverage ratio for REITs, is at 4.5 times, which is healthy. And interest coverage, how easily can they pay their interest? A strong 5.6 times. So overall, very strong financial health, giving them flexibility.
Sounds like they have good access to capital then. Any recent financing moves?
They do. They recently closed a $240 million unsecured term loan. And they used those proceeds pretty strategically, paid down some secured debt, and also funded a $56 million loan to one of their joint ventures.
Okay.
It just highlights their ability to tap the markets. And it seems like lenders really value their specific assets. Those high-quality, age-qualified manufactured housing communities still command the best financing terms.
Right. Reflects confidence in that niche. Okay, finally, let's look outwards a bit. How are they navigating some external factors, and what's the future landscape look like? How about demand from Canada? That can be a factor for some of their northern and Sunbelt properties.
Yeah, they're watching Canadian travel closely. They did note that the early bird reservation rate from Canadians was down about 20% compared to last year. And they saw maybe a bit of pullback from Canadian transient customers in places like the Northeast and the Pacific Northwest.
Okay.
But their expectation, based on history, is that reservations will pick up later in the year. You know, as the weather turns colder up north, more Canadians will likely head down to their Sunbelt properties. It's a pretty standard pattern.
And that proposed visa fee increase for some visitors, any impact expected there?
The $250 visa integrity fee, the full impact, isn't clear yet. But ELS pointed out that actually a lot of their Canadian customers don't need visas for the typical short stays they do anyway, so maybe less impact than feared.
Got it. And thinking about growth through acquisitions, is that market active for these kinds of properties?
The acquisition market itself has been pretty quiet lately. ELS seems to view this as just part of the normal cycle, though. You know, periods of low deal volume are often followed by activity picking back up.
Right.
And the underlying structure of the market hasn't changed. Ownership in both the MH and RV space is still highly fragmented, lots of smaller owners. So the potential for future consolidation for ELS to buy properties is definitely still there. It's just hard to even talk about pricing, about cap rates when there haven't been many significant deals recently to set a benchmark.
So the market's just waiting a bit.
Seems like it. Waiting for maybe rates to settle or sellers' expectations to adjust.
Okay, so wrapping this all up, we've really dug into equity lifestyle properties here. I covered a company that seems to have found this really effective blend, right? Stable manufactured home communities on one side, the more dynamic RV and marina resorts on the other.
Yeah, and their financial performance really reflects that blend. Strong results, strategic investments aimed right at specific demographics, particularly older adults, and that really impressive handle on expenses. It all points to a very resilient business model.
They seem to consistently deliver value within what is, a pretty unique corner of the real estate world.
Absolutely. And their success really seems tied to understanding and providing what people need. affordable living, community-focused environments, and leisure options, especially for that aging demographic, which I think leaves us with an interesting thought for you, the listener, to maybe chew on.
Go on.
Given ELS's model, focusing on this stable, community-centric real estate, what does it suggest about the bigger picture? What might it tell us about the future of affordable housing or how leisure preferences might evolve, especially considering the demographic shifts and economic changes happening all around us?